CPI has upset the apple cart a little bit. Let me put on disclaimer. CPI has upset the apple cart. Market doesn't know what it's doing. We've got, as I am talking now, which is 6 o'clock on Tuesday, 13th of Feb. Nasdaq's taking a bit of a hit. Russell's taking a big hit. Yeah. USD JPY nudging on the old 150 level. Something for everybody today. And anyone who's watching natural gas is a one-way streets at the moment. In fact, USD JPY 150.80 at the moment. Wow, okay. Right, let's get this show on the road, ladies and gents. By the way, worth just mentioning, apologies for last 2 weeks ago, the last webinar, like off, we had technical difficulties. It was just a bit of a shame because a lot of you were looking forward to that one. But anyway, did it late. We came on late, did it. It is up. You can watch that. There's a link available. I'm sure Pepperstone has sent out the recording link for that. But you can also see it on the Traders Mastermind website if you would like to have a look about a little bit more at Wyckoff. Okay, so let's get started. 20 seconds early. That's fine. We've got everyone in here. Psychology is interesting, right? Psychology is, I think, is the biggest lever. It's sometimes the least popular. Like if we're talking about strategies and nuances and stuff, super mega popular psychology. So if you're here, you are one of the few taking this game seriously enough to actually spend an hour of your time on a Tuesday evening, wherever you may be in the world, learning to improve your trading psychology, which I believe is probably the biggest lever you can pull. So anyway, how this works, ladies and gents, if you don't know, by the way, I'm looking at my other screen here, just making sure everything is as it should be. How this works is I've got some things I want to share with you, and you can type in the Q&A if you like, and at the end of it, we'll have time to go through answering your questions. If I can, I will definitely help. If I can't, I will be able to probably push you in the direction of someone or somewhere that can. I've been trading for almost 23 years now. I don't even know why when I say that it makes me cringe, like 23 years, 23 years in March. So I can obviously help in a lot of ways, but I don't know everything. I don't claim to know everything. I can share just my experiences and what's worked for me and what I observe in others and see others' success and kind of take bits and pieces and share that with you. And the objective being that you can take, little bits here and there and improve your trading. And that's the same whether we do these webinars. I also do a podcast on Traders Mastermind, Traders Mastermind podcast. I send out a daily email. And obviously we've got our premium membership product with your training tools and all that other stuff there. So let's get rolling. Disclaimer, of course, we know, hopefully you know by now, spread bets and CFDs, pretty complex instruments. Leverage works in two ways. Sometimes it's good when it's working in your favor. Sometimes it can be bad. So please understand the product and instrument you're trading. Okay, today, was about insights for optimizing your trading decisions. And the great quote from Jesse Livermore here: the most important quality for a trader is to be a good decision maker. I might lose money, but I always learn from my decisions, whether good or bad. And really, that's what I want to dig into today is how we make the decisions, why we make decisions. Because I really believe that if you can get a grip on understanding why our brain works in the way it does, then we can optimize for that and we can improve our decisions. We can be careful of the warning signs and just be very, very self-aware. A little story. That's 15 years ago, I want to say. I'll group everything 15 years ago in my trading journey. But the early days for me, I really struggled with discipline. I really struggled with trying to get things right and just breaking rules. And I kind of didn't have an idea of why I would think differently in the trading day. And you may be the same. It's like something comes over you in the trading day. Something takes over you. And it's almost like you wake up and go, well, why have I taken those trades? Why have I done this? Why have I done that? And that's because our brains are hardwired to have these biases, to have these kind of ways of making decisions. And actually, if we can be aware of it, it can really accelerate our learning curve. Honestly, it really helps us think, okay, well, actually, I'm normal. I'm acting rationally as a human does, but how do I combat it? How do I make sure I don't kind of default to these human settings, if you like, because they don't always serve us as traders. So that's what I'm going to talk about today. Markets all over the place today. CPI's cause a real mess. And by the way, if you want to kind of listen to someone and follow someone who knows his stuff about this, then I recommend following Michael Brown on Twitter. His handle is, let me just have a look at my phone where his handle actually is. Is it Michael Brown? At Mr. M. Brown. He really, really good guy, and he shares his insights into things like CPI, into what the impact is going to have, how people are positioning, how traders are thinking about this, what it means. And he says it in layman's terms, like, I'm not an economist. I just care how the market responds to the data. So actually just having a finger on the pulse and having someone who kind of knows what's going on and can decipher it and say, this is bullish because X, and then I can go, right, that's what traders are thinking. How is price responding? So I definitely recommend giving him a follow on Twitter. Anyway, let's get rolling. Let's get started. We've got 45 minutes. We'll do 50 minutes for Q&A at the end. And by the way, right, this is completely off topic, but this caught my eye. There's this crazy, ridiculously off topic, but our stupid things that people do. This is maybe a parallel. There's a thing called Atherton ball, right? In the UK, I think it's in a village in Warwickshire, and it's this crazy game where you've got these two sides of the village fighting over this giant ball that's made like a leather ball, and it's been around since 1199 or something like this. And there's footage of people literally punching each other, kicking each other, trying to get this ball. I don't know what they're doing with the ball. I think you got to get into a goal or something. But I remember watching this, thinking, why are people even doing this? And it just shows you, right? Human nature is what it is. There's this tribe mentality, this whatever's triggered that they are going to put themselves into harm's way and start punching people and doing all this stuff for the credibility of getting a ball in a goal for a village tournament. It's not like Olympics, not we're talking some sort of crazy MMA fight or something. Fine, there's something maybe to be said for that, but I just thought it was funny, especially when we're trying to think of why our brains work the way they do in trading. Anyway, let's go back to trading. But you can have a look at that. It's really quite humorous. Okay, topics for today. What I want to do today is this. We're going to talk about cognitive bias identification. This is a complicated word for saying, how do we come up with the decisions we come up with, and why do we come up with those decisions? Building confidence and certainty, big one for traders. Tactics and techniques that you can deploy. There's no point in me giving all this theory and rah, 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 yeah, you should do this and that, without saying, hey, try this out to help you do this. So my goal today, always come in with a goal, and that's to help you get a better understanding as to why you make the decisions you do, and then give you some tactics and tips to help improve your decision-making process. That's it. And if I can do that, man, that's going to really help you, because understanding that we're human beings and we have these biases, we make poor decisions under certain conditions, and in trading, that's a death sentence, right? We're making constantly poor decisions, poor decisions, poor decisions. Doesn't matter how good our strategy is, doesn't matter how big our edge is. If we're just constantly making poor decisions, we're never going to get to where we want to be. So really, really useful topic, really, really useful thing to get a grip on. And hopefully kind of spark something in your mind. You go, yeah, I like that. I like the kind of thinking of that. I've got some ideas, and maybe you go away and do some more research. Thinking Fast and Slow is a great book on this. The Chimp Paradox, another great book on this. But these are stuff that maybe we can cover later on if we get the time. Okay, so let's start out and think why we make poor decisions. And by the way, have you ever been in this situation where you've kind of made a plan? You've got your journal, your jotter, your checklist. I'm going to do this, and you sit in front of the screen. Market kind of starts rolling, and you make a good trade, and maybe get stopped out. And then all of a sudden, you start doing things that you said you weren't going to do. You chase a trade. You maybe take a bit too much size. You maybe move the stop. You don't hold the trade like you said you would. Something happens in the heat of the battle, at the moment, that makes you change the way you decide and operate. And that's what we're going to dig into is why do we do that, and how we can kind of bypass that. How can we rewire our brain, number one, and bypass those, number two? So the shortcut is to bypass it for now, and then over time want to rewire the way we think about things, because we've all been in that situation, especially if you're a day trader, if you're an active trader. The stress, the heat of the moment, the market movement entices us to do things, and we kind of sort of only snap out of it and go, why the hell have I done that? All of a sudden I've done these silly trades and I've done some damage to my account, and you almost wake up out of it. It's because we're hardwired to do it. So number one, we're human beings, right? We're never going to be robots. We don't want to be robots. If you want to create an algo, that's fine. That's one route. But if you want to be a discretionary trader, we have to embrace the human element. And I believe that is what gives us the edge. And if you go back onto one of the Market Wizards books, I can't remember which one it was, Jack Schwager, who's the author of the Market Wizards book. And if you're kind of new trader, absolutely recommend these Market Wizards books. All of them should be mandatory reading for all traders. In one of the books, he says, when I go and kind of find the traders to work with and chat with and interview, I audit their track record, I look and see their performance. And he said that, by far, discretionary traders have a way better track record. He has some systematized algo, if you like, traders in there. But one thing he said is the performance is often not poor. There's lots of profitable algo traders and profitable funds out there running algos. Of course, Renaissance Medallion Fund is a completely different animal. But the point is that the discretionary element of trading is really where a big edge can be. So we're human beings. One, we don't want to change that. Two, we have emotion. We don't want to change that either. Denise Schull in Market Mind Games, I think was her book. She said this great. It was she's a trading psychologist. We have emotion. Let's not try and suppress the emotion. Let's work with the emotion. And we have these unconscious biases that affect our decisions, and that's a big one. When you crack that and you realize that, the game changes. It just changes how you perceive your trading. A great trader is very self-aware. I think we all know this, and also knows when those biases and emotions are impacting our decisions. So first step is knowing the enemy, if you like. And enemy, I don't like using that word so much. I don't know why you put it in the slide, because I always feel that let's take a sidetrack for a moment. When we have that inner voice that's saying, make this decision, do this, do that, and we call the chimp from the chimp paradox, System A, I think is the other, is Thinking Fast or Slow, call it System A. Can't remember how he refers to it, but that's trying to help us. It's not trying to hinder us, but it just doesn't help us when we're trading, for example. It's saying, grab the profit, take the profit. Or, grab that money, you feel good, you get the dopamine hit. You feel like a good trader if you grab that little small profit. And then you can kind of say, listen, I know why you're saying that to me, but actually, I'm trying to hold trades. I understand you want me to feel good. You want to protect me short term, but work with me. Let's hold this trade. Let's see what happens. I'm trying to move things forward. I'm trying to stretch my trading ability. I'm trying to get better at trading. And kind of rather than, being it up and saying, no, 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 you can kind of work with both sides of the brain. Maybe going a little bit off piste here, but it's something to consider. Okay, so decision-making biases. I'm going to run through some of the biases in some sort of detail, not massive detail. I'm not going to here to bore you to death, but it'll be worth your time. I think it's well worth your time. So loss aversion, confirmation bias, recency bias, hindsight bias, anchoring bias, a big one for traders. And the idea being, if you're aware of them, you can avoid them, or at least know if they've had an impact on your trading decision and go, oh, hang on a second. I think I might have had a bit of confirmation bias in that. Do I need to remake the decision? And we'll go through a process for making a better decision towards the end. But at least then you can go, that might be influencing me. Do I, okay, let me just hold back a little bit. Let me be aware of it. Because being self-aware as a trader is the number one thing. I recently did a podcast discussion, and self-awareness is just huge, right? It always comes up with the best traders saying that, people who are observing the best traders saying that, self-awareness. And I know from myself, and from yourself, when you're self-aware and you are in tune with how you're thinking, and you're auditing what you're thinking, and you're thinking about what you're thinking, then you make the best trades. And that's our job as active day traders or active trade or position traders, however you want to describe yourself. We really want to be super self-aware. So let's start off with loss aversion. Bizarrely, for whatever reason, humans, traders, tend to prefer to avoid a loss rather than taking equivalent gains. So if you said, hey, lose 500 bucks, or in this example, 100 bucks, that's more painful than the equivalent pleasure of making 100 bucks. And they've done studies and studies and studies on this relentlessly, relentlessly, relentlessly. Human beings are hardwired to feel more pain in the 100 buck loss than making 100 bucks. They've made up all different studies, and they've kind of put scenarios of people in the street and done this. In other words, if we translate it to trading, it's tougher to take a loss. That could be on a trade basis. It could be on a daily loss limit. How many times have you got to, I hope you have a daily loss limit, and I hope you have a risk management methodology that says, hey, if I reach this loss in the day, if you're a day trader, that is, I will walk away from the screen because I tend to do more damage, and very rarely am I going to recover from that loss. And if you swallow the loss, comes the next day. So if you've got that, you know how difficult it is sometimes to walk away. And that is because humans are hardwired to have loss aversion. So know this, and we can work around it. More value is placed on P&L once it's locked in. I don't know why I missed off the last sentence there. But more value is placed on your P&L once it's locked in rather than unrealized P&L. Right? If you lock in 200 bucks, for example, that has more value than being unrealized. But actually, it's the same. It's the same. So thinking about, loss aversion, avoiding the loss rather than taking the equivalent, thinking about how that affects your trading and thinking, hey, do I have loss aversion? Is there a reason why I'm not prepared to walk away from the day? Why I'm not prepared to just pump the brakes and stop trading? And if you kind of compare these risk aversion to risk seeking, both these things kind of go, they're obviously other sides of the table, but you've got to be careful you're not swinging wildly from one to the other. So conservative behavior, when seeking gains, risky behavior in trying to avoid a loss. Think about this for a moment. Let's kind of I'm going to kind of step, 1 foot in the kind of the theory and then 1 foot back into the real world in the trenches, in the trades that you and I do day to day. Think about this. When you are in a trade, how many times are you kind of really desire to hold the trade, to add to the trade, to get aggressive, to really kind of push the throttle down? This trade's working, man. I'm going to hold this thing. I'm going to add to the trade. I'm going to do this. That's tough, right? A lot of people struggle with that. And actually, a great book by Tom Hugard, Best Loser Wins, talks about this a lot. He is a big fan of adding to the trade, adding, so he is really kind of seeking risk when it's working. Whereas most traders the other way around, they're kind of, I've got a bit of a gain. Let me take a little bit off. Or let me pull stop up. Let me protect it. Or, let me be. And there's a fine line, right? There's a dance to be made, a trade off to be made. But ultimately, you want to be careful you're not falling into that trap. It's the same if you're trying to avoid a loss. We've probably all throughout our careers at some point taken a risky trade to try to recover a day red. So you read on the day, and if you lock that in, it will be a loss on the day. You don't want the loss. And so you take a trade that's maybe too big, maybe it's in something you shouldn't be trading. You indulge in risky behavior to avoid the loss. And so we have this real dichotomy of, hey, risk aversion versus risk seeking, or being very, very averse to risk and conservative when we're trying to get gains and trying to make money and trying to really maximize the profits. And then we're kind of risky and doing these silly, crazy things to avoid the loss. Doesn't make sense, but this is what we're hardwired to do. So we have to unpack that and we have to be very mindful of that. And we don't fall into the trap and saying, hey, why am I doing this trade? Is it because I don't want to take the loss today? Is it because I don't want to take the loss on this trade? Is it because my equity curve sucks at the moment? I don't want to make it look worse. And you start doing more stupid, risky. That's basically what tilt is, right? We've talked about this before. Going on tilt is something that happens because you kind of have the loss. No one goes on tilt when they made a gain. You don't suddenly go on tilt and start making these wild, crazy trades because you made loads of money on the day. No, of course you don't. It happens when you've got the loss there. And the reason you go on tilt is because you want to avoid that loss. So watch out for that. Examples here, we covered bigger trades to recover from drawdown, locking in a small gain versus holding a trade, holding a loser in hopes it recovers versus locking in a small loss. Be mindful of these. And also, I want to say this is normal, right? Normal human behavior. So if you do any of these things we're talking about today, that's normal. And don't think, oh, am I the only person who does it? Why can't I stick to the rules? Why do I do this? Because you're a human being. And for some reason, we're hardwired like that. It must be hardwired like that for longevity. It's why we're still here all these years later, because we're able to, these things have served us. But in the trading arena, they don't serve us. And so it's our job to be mindful of that and become different from the crowd, different from the mob, different to the way the crowd and everyone else thinks, and adjust it and tweak it, because that's how we can really outperform. So, reluctant to cut loss, reluctant to cut losses, should I say, snatching at profits. These are the kind of things. Over trading to recover losses. Watch out for these things. Risk aversion, risk seeking bias. Risk aversion when you've got a gain, risk seeking when you're in a loss. Impulsive decisions. Be careful. 5 things to watch out for there with loss aversion and in the real world of trading on the front line. When you in the markets, you've got your broker account up, you've got your Pepperstone account up, you've got your ticket ready. Just be careful. Just be mindful. Loss aversion. Right. Let's go through some more. At the end, wrap it all together. Some tactics to help avoid these. Confirmation bias. This is a sneaky one. Oh, God, it's subtle, but it gets you. It gets you. So, confirmation bias is taking information to support an existing hypothesis. And my example here is you think the market's bullish, so you start getting all the information to confirm that thesis. Another one, which we'll touch on later, is I'm a bad trader, and you start to then add stuff to support that thesis. So how do we avoid this, and what is it? So the one thing, a great example is this, okay, is very often you make, and this happens when if you're rushing a little bit in the morning, I think if you're coming into the trading day, you come in with all the best intentions, do your pre-market prep, you go prepared and get this. And sometimes people rushing a little bit late, they don't do the prep. They go, oh, I'll just carry on trade. They look at the market and they take an impulsive view. It's going up. It's gap down. It's going up. It's gap down. It's going to go low. Whatever it is, and that might just come from anything. And then if you're not careful, by the way, this happened during the trading days, but not necessarily just because of that, you go, oh, I think the trend's overextended, we're going to bounce. And that, if you're not careful, then it blossoms a big idea just from that little seed that you really didn't think about. You just had a sudden, oh, it's gone too far. And so you start adding more layers of information to support that initial knee jerk reaction that had no basis whatsoever. Trend's gone too far. Or I think we're due a bounce, or whatever it may be, and you start adding more things in. Well, we're a soul in the RSI, and we've done this amount of points move, and you start to add all this stuff in. In reality, all you're doing is finding things that maybe support that initial knee jerk kind of analysis. You're not sitting there and making a careful analysis on the market and saying, okay, give me the pros and cons, right? You're ignoring other important variables and you get overconfident decisions and all this type of stuff. And also, you got to be careful, you're not in an information bubble. I know that many people probably aren't. But you got to be careful that you're not reinforcing that idea. You're being aware that this is a game of, okay, I might have a gut judgment, I might have an intuition, but I need to be objective still. So yeah, so trusting gut without cross-checking for bias. And if we go back to slides, one slide for a moment, hang on, trying to work on my mouse here without going too far. Uh, on the bad trader aspect, more on it later. But this is one thing as well. If you suddenly say to yourself, hey, I'm a bad trader, I'm a poor trader, and you are referencing your performance yesterday, you're referencing your equity curve, you're referencing when you broke your rules, you're referencing all the things that support that idea. Well, I'm a bad trader, right? Then all you do is you reinforce and reinforce and reinforce and reinforce. And I'm talking about now, but I'm going to later because it's so important. This, you have to flip the switch and go, all right, those are fine things that aren't great, but look at the good things. And you want to reinforce the feeling that, hey, my process is good. I do my checks more often than not. I stick to my risk rules more often than not. I'm researching strategies. I'm doing homework. This is reinforcing that you're a good trader. So something to be definitely aware of. Okay. So confirmation bias, just to recap on that, be careful that you're not just, for traders, you're not making a snap decision on the market. It's gone too far or it's going to reverse or whatever it is without, and then reinforcing that, be careful and mindful and go, hey, you know what? That's one idea. What's another idea? And I will talk about techniques in a moment, but that's just something to be very careful of. Hey, and especially for day traders, chart comes up, you make a judgment, you reinforce it. Watch out, watch out. Because you can always have a really intellectual reason why something's going to go up or down. I can give you 10 reasons, real good reasons why you should be long, and 10 reasons why you should be short. And it doesn't make any sense, right? It has to be objective. Okay, enough on that one. Let's talk about recency bias. So this is where you give more weight to recent events, trade performance, market movements. And this is really, I guess for traders, it's, you've got to be careful you're not ignoring the context of the market. You might be like, oh, the market's, always bounced after this. And yeah, fine, maybe that's going to do that. But you've got to be careful you're not saying, hey, it's always going to do that. And the same with your performance as well. If you've had a really good couple of days, you might think, oh, I'm Mr. Trader, I can do this and do that. And you have this kind of overconfidence. And rather than being objective and going, hey, the chances of me having this streak forever is almost zero. So at some point it ends. I just need to be mindful. I need to be careful. I'm still managing risk. I'm still doing my decision making matrix. I'm still being very, very careful. So recency bias is one to definitely be careful of. And it's not so much, actually. I have to say, it's not the biggest one, but it's just being mindful of it. Okay, hindsight bias is a big one for traders. Big one. The I knew it all along effect is what it's otherwise known as. So, after something's happened, i.e., a market move, we tend to think, well, I knew that was going to happen. That's why I went long. I knew it was going to bounce. I just knew it was going to bounce. And you got to be careful with that, right? Because there's a big element of luck in trading. And that's like, oh, God, that grates on a lot of traders. Like, What? Luck? Sadly, well, not sadly, because there's a way around it. I did a podcast. This is my recent podcast going up 2 days time. Talked about this in detail, so I'm not going to waste your time here now. But each trade, there's an element of luck, right? But the idea is that over time, that luck evens out and our edge plays out like a casino. When a casino is allowing a customer to spin the roulette wheel, they don't know what it's going to land on. The customer could get lucky, and that's unlucky for the casino. They know if he sits there long enough, he does 1,000 spins, all that money is going to come from his bank account into theirs. Thank you very much, sir. Have a free beer. Come again. They know that's how it's going to work. And so you've got to be careful that you aren't saying, "Oh, I knew that was going to happen when you take a trade." It's like, okay, be objective about it. Like, okay, I took this and took that. I didn't know it was going to happen, but the odds are on my side. I believe if I take this 100 times, it's going to work out well for me. Okay, let me not add too much weight. Let me think I'm a big genius for getting that right. That's just one trade. There's a little bit of luck involved in that specific trade being right, but I believe that over time that's going to play out. And you got to be careful because you don't say, "Oh, well, I took that last time. I'm going to take it again. I'm going to take it with more risk. I'm a really good trader. I can spot these moves and stuff." And you don't learn from it and say, "Okay, that was a great trade. Fantastic. Thank you very much. I'll take that profit. Great. What can I learn from that?" And not over egging and boosting your confidence, saying, "I knew it was going to happen all along," because nobody knows what's going to happen in the market. Sure, we have edge, we have positive expectancy, we have all this type of things that we try to stack up to help improve the chance of that trade working or the chance of the trade working over time if we take a number of trades. But we don't know. It's got to be very careful. I think, the older you get in, well, the more experience, you're going to say older, the more experience you get in the market, the more humble you are and kind of like, hey, listen, great, it's working, but, you know, I don't know what's going to happen on the next trade. Next few trades could hit my full stop. I could hit my loss limit. That's the way it goes. And it's being that way and just being kind of, I'm just going to move forward regardless and thinking of it like that rather than, being, "Oh, I'm such a great trader." You've got to be careful with the trap that you can fall into, especially if you have like a run of decent trades and a run of success. Okay, anchoring bias. Ha, another good one for traders, big one for traders, this. Relying too heavily, no row there, heavily on an initial piece of information, the anchor. For traders, without any shadow of a doubt, to quote Peter, he loves to use that phrase. Peter's, by the way, he runs some of the coaching calls we do in Traders Mastermind if you're not a member, and he has some real catchphrases. In fact, the podcast he did, his first ever words that came out of his mouth were "for crying out loud." That's the type of trader he is. Okay. So relying on an initial piece of information for traders, this is absolutely the price you enter at. And you've done this, I've done this before, and get rid of it, it doesn't serve you. So you take a trade, bang, let's say you buy at 100, right? Now you're watching price in relation to the anchor, the 100. You're saying, which is an arbitrary entry, right? No one gives a what about where that entry is. The market doesn't care that you bought 100. Okay, 100 might not be a great example because it's a round number, so maybe they do care. But let's say you bought a 101.58, whatever it may be. All right. No one cares. Market doesn't care. Nobody cares but you. So now you are looking at the market through the lens of, I am long at 101.58, whatever I said. Okay, it's 101.50. Great. And you will start observing price using that as an anchor. So when price goes above it, further away, and you're long, you're like, "Oh, lovely, that's really good." And you think, "I might take some profit or I might do this." And when it's gone below, and really you're looking at it from that perspective. You're anchoring your feet down on your entry and you're observing how far the market's gone against you, adverse excursion. You're looking at your favorable excursion and you're looking at it from that point. So when it's moving in a big movement in your favor, you're like, "Wow, it's great, I'm going to take profits." When actually the objective assessment might be, this thing's just getting going. I had a damn good entry. There's no way I'm closing this trade. Look at it objectively. It's just started to rip off the lows. It started to flag, congest, find some support, little spring formation. Looks like it's about to fire off another leg. And if you looked at it objectively, you'd be like, "Hey, that's fine." And if you're not using an anchor, whereas if you're looking at it from anchor perspective, you're like, "Oh, I'm up X. That's great. I'm going to snatch it." No, I believe that's a wrong approach. Same with your stops, right? You're anchoring and it's market's moving against you, and you're like, "Oh, you know what? I might cut this trade and it didn't look great." Maybe your entry was just poor, but you're looking at it from perspective of what your entry is rather than looking at saying, "Hey, you know what? It's probably a fair pullback in the scheme of things, and actually, I was just a little bit early on it. I either need to adjust it, or I need to say, okay, I need to reduce the size, or I need to widen the stop." So whatever the point is being very careful. You're not looking at price action through that lens of where you took the trade. It's a super subtle and common thing that traders have done. I'm sure you've done it. I see traders doing it all the time. I know I've been guilty of it, and I'm a human being, right? Even now, I'm like, careful. You got a good price there. There's no need to think this is not going to keep going. You got a great price. Don't look at it based on that price. Forget about that. Just look at the chart objectively. It's starting its first leg of a reversal. Don't touch the damn thing. Let it pay you for being right. As an example, if you've got a great price, obviously the same applies the other way around. So anchoring bias, be careful of that. All right. So we're on good timing. Okay. So what? So what? Who cares, Mark? Who cares? Well, you should care because all of these can impact your decision making as a trader. Yeah, we're human after all, right? So what can we do about it? And this is the kind of meat. So now we know some of the main things, and there's some others as well, but I don't want to go through every single one of them. I think those are the big ones. Obvious step one, get your trading plan. I sound like a broken record. I'm not going to stay on this slide for long. Don't worry. But honestly, it solves so many things. Simple plan. Follow a trading plan. Take as many of the on the fly decisions away from you as possible because you won't have those biases creeping in because you made the decisions beforehand. How much I'm going to risk, and my strategy, when I'm going to take the trade, my filters, when I'm going to enter the trade, my triggers, my targets, my stops. And the more you can take that burden off your shoulders, the easier the actually important decisions are. Like, okay, maybe you leave part of it up to discretion. Like, okay, do I buy on the close of this bar? Do I wait for this? There's some element of discretion there. You don't have to be a complete algo if you don't want, but it helps alleviate this. And then you're not succumbing to biases so much. It's not foolproof. Like, I'm not saying if you make a trading plan, you're not going to have these biases. You're human beings still, but it helps lift that burden of the on the fly decisions because the on the fly decisions are the ones that screw you over. And you know this, and we all know this. It's that impulsive nature of taking a trade, taking a trade, doing this, doing that, moving the stop, not taking the trade off when we should do. That's what messes us up. And so the more we can do, the more decisions we can make that are not in the heat of the moment, I think the better results you'll get. Um, Initial bias. So this is a bit of a repeat of what I've said before, but I think you've got to be so careful. This is a day trader, especially coming in, you're conducting your pre-market, like what's happened overnight, blah 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 blah, and having a thought of, oh, the market should be doing this. Just be careful about making a snap judgment. If you make a snap judgment, just go, okay, well, okay, I might think it's long, but wait, step back. What about short? And almost before you make that initial impulsive decision, and then reinforcing it with confirmation bias, give yourself time to say, okay, well, I think long, but what about short? Give me some ideas why this would be a short and waiting for a pullback to go short rather than long. And you can kind of then come up, and even you might then come up with the same thesis. I still think it's long, but at least then you have looked at and assessed the opposite side of the deal. And that's important. I think that's so important. We've got to be so careful we're not completely focused on one thing or the other. And actually, honestly, it's okay to say, I don't know, man. I thought it was long, but now I'm sort of looking at the short side and I've kind of argued them out. Maybe there's nothing at the moment. And then you go, okay, what would be a good long? What would be a good short? And you start to play the game of really dialed in trader that says, if I got a flush down to this level that did this, and this, now that's a good long. Yep. Okay. What about if I got this on a short? Now that's a good short. Now you're anticipating, you're not reacting. And that's the whole key. That's a completely other topic, but stems from this initial bias of saying, that's that now that will be a good trade. There might be no trade on now, but that will be a damn good trade. Okay, let me wait for that. Let me set my alerts. Let me do this and do that. Prepare for it. Play the game of chess rather than checkers. You're playing the reactive game. You're getting stuffed. You're playing the careful, considered planning game, anticipation game, and things tend to work out a lot better. And again, it reduces that impulsive nature of stuff. So that's something to think about as well. Okay, so building confidence. I wanted to really touch on this briefly. I know I've talked about this before in depth, but it's a real common problem. Traders are saying, "Oh, you've got no P&L, right? If you're a trader who is developing, let's say, and you don't have any P&L to kind of prove, if you like, that you're a trader, which is, I'm going to dispel that for the moment. I get it. We're all in this to make money, right? We're all trying to Make as much money as possible if you like with the least amount of risk possible, and all the disclaimers that go with that. Okay. But you've got to be very careful in your early days. You're not staking your worth on your P&L because you're going to lose. Because no trader, oh, there might be one out there somewhere, but almost no trader starts out and starts making money from the beginning. The ones who make it, they have to go through the mire. They have to wade through the treacle. And so if you're the trader who stakes his identity and confidence on your P&L, in the early days, you ain't going to be very confident. And you need confidence to be able to execute the trade, to hold the trades, do the stuff that gets you to the next level. So you kind of shackle yourself completely. So work on building your confidence, and that will use the confirmation or turn the confirmation bias to your advantage. Why? Because if you start to believe you're and by the way, I don't buy into this nonsense. You stand in the mirror and go, I'm a great trader. I'm a millionaire. I'm a blah, 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 blah. I don't buy it, right? You can't fool your brain. Your brain goes, mate, you're not. Your equity curve sucks. You're not made a penny for the last quarter. And I don't believe you. However, if you reframe that and say, I'm a great trader because I've been putting in the work. Now, my equity curve isn't where I want to be. My P&L is not where I want it to be. Fine. But that's one side for now. That's going to come later. I am identifying as a great trader for someone who is putting in the work, and you find the evidence to support that. Do my pre-market prep, doing some research the weekends, turning up to these webinars, increasing my knowledge. This is all the put in the work, and work instills the worth, right? The work instills the worth, and you build your confidence from that. So that then when you come into the trading day, you're like, hey, you know what? My equity curve isn't where I want it to be. It's coming. But look, I've learned this. I've done this. I've been studying this. I've got my plan. I'm sticking to my plan. I've been doing this. I'm doing that pre-market prep. I've been doing all the things that should induce confidence in me. And then you start to use confirmation bias to your advantage. You say, yeah, look, while everyone else was drinking beer, I was doing some research on this. I was going back and looking at my charts. I was going back and studying a strategy. I was using the replay feature on TradingView. I was jumping onto a webinar and taking some notes. I was reading. That's the stuff that builds the confidence. And then over time, that then hopefully your equity curve then takes over. And then your confidence comes from not only doing the work, but it comes from your equity curve. And then you're in a really powerful position because even with drawdown or even with stagnation, you're like, so what? So you're in a really powerful position then. So one thing to do is also learn from your decisions, right? Reflection process and journal. And also in your journaling, just not the operational stuff like I got this profit and this is what the trade I have, but also how you made the decisions. So what is your decision making process and how can it be improved? So, and I think you got to be careful that when you make a great trade, you don't go, that was a great trade. I did a great trade there. I bought loads, sold at this, blah, blah. Yeah, give myself a pat on the back. Fine. I don't say you shouldn't do that, but you should be careful that you look at that and go, was that the correct decision? When I made that decision, was I influenced by recency bias? Was I influenced by confirmation bias, anchoring? But I know those things that they cloud my judgment because if they did, that's not a great decision. You might have got away with it, and you might have been had a good trade out of it on that one unit. But you know that if you duplicated that 1,000 times, that bias would probably influence you negatively, and the returns wouldn't be so good. So just be careful. I'm not saying don't. Honestly, I'm not saying don't celebrate your wins. You should celebrate your wins. This game's tough, right? So you should be there giving yourself a pat on the back for doing good things. But be careful what you give yourself a pat on the back for. You end up reinforcing stuff that isn't going to serve you. Example is if you're kind of trading, you've got the loss aversion, you're down on the day heavy, you should have quit for the day, but you fight, so to speak, to get back. You're back to green, like, oh yeah, look at me. I was deep in the whole red and I recovered to green. That's just deadly. You might think, oh yeah, you feel good because you came back to green. It does feel good, right? It does. Let's be honest, it feels good. Just like eating a whole massive pizza feels good in the moment, but it doesn't serve you. It doesn't serve you. So just being careful that you learn from your decisions, and if you do make something that actually doesn't serve you long term, just be aware of it, right? Don't extract the fun out of this business because tricky as it is, but just thinking, how did I make that decision? How do I come up with that trade idea? Timer hack. This is it's a really good tip, and I bang on about it so much, and people must be getting so bored of me saying about this. I got a timer on my desk. It doesn't look like that. It's a little bit more advanced than that. Not that it matters. You don't care whether it's an bloody egg timer. It just gives you just pauses. Use the time before you make a decision. So if you're about to take a trade, about to take a deal, just give you a chance to hit the timer. Whoa, pause. Let me just double check any biases creeping in here. Hmm. Why am I making this decision? Is this accurate? Would I want to make this decision 100 times in the same direction? Context. How much risk am I taking? Where's the risk? One thing I did, which fixed kind of this impulsive trading for me, was timer and then just repeating. Where's the risk in the trade? 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 Answer that question. And sometimes you go, oh, it's a bit early, pal. You're buying a bit early. One more flush, I think you need. Let's just wait for it to. You start to then hypothesize. Or you go, yeah, I'm in now. Done. And just a little bit of a break on your impulse just helps you just put things in perspective. Just pump the brakes a little bit. Circuit breaker timer is such a. If I was running a group of traders, I would mandate a timer on everyone's desk. Now you don't have to use it if you're not having problems with stuff, but if you're in problems with impulsive behavior, over trading, all these kind of biases, I'd be like, listen, the timer hack works. Just put the timer. It can be 30 seconds. It doesn't need to be ages. It could be 5 minutes, whatever you want. But you must put the timer on and think about X before you make the decision. Whatever X is that's causing you problems. Am I taking this trade because I have loss aversion and I tend to trade poorly and draw down? Whatever it is. That just helps. Whoa, pause things, pump the brakes a little bit, move on. I know I talk about it a lot, but for the sake of whatever the hell it costs, 7 quid or something, it's a game changer. And then coming up with your decision making framework, right? So we get a little bit nerdy here, and maybe you don't have to, but what are the and think about when you're making a decision, is can you make a better decision? Can you come up with a decision making process that makes things better and easier for you? And by the way, what I mean by this is I came to realization that I was thinking about too many things, and maybe you are too. When you make the decision to take a trade, you're thinking about this and this and this and this and this and this and this, and you're overwhelmed with data because you're trying to make the perfect trade. You're trying to get all these things and go, oh, but the RSI is this, yeah, but and that's correlated to bonds, and the CPI is doing this, and we're at support, and maybe, and you're taking all this data in. You don't need it. There are three big variables that impact your trading decision. What are they? And how long should the decision take to make? So, in other words, you're considering going long, a trading plan says going long at support. You've identified support. Blah blah, blah. Okay, what are the three big variables that decide whether you should take this trade or not? Probably the daily context. Probably time of day if you're a day trader. Important that if it's the end of the day and it's hammering through lows, you maybe don't want to go too long. What else could it be? How far away from the VWAP? How far away from the open? What's caused the move? Is there a catalyst? Whatever it, you up to you to decide. Anything else doesn't matter. If that's enough for you to make a decision, how long should the decision take? You don't want to be instant. It shouldn't be an impulsive decision, reacting. And again, it shouldn't be sitting there dithering, going, well, should I do this? Should I do that? Oh, let me just bring out the 15 minute. Let me bring out the 5 minute. Let me bring out the daily. Let me bring out the monthly. No. Have a decision making framework that helps you make those trading decisions quickly and effectively, but not too quick, right? You want to make them good, promptly, timely, with the right amount of variables that you need to look at. Anything else is noise. It's going to add clutter to your decision making process, going to leave you with like a confidence, and it's going to put you in a really uncomfortable position. The art of trading is to take your trade, flood yourself with certainty that this trade's going to work, but have a stop just in case it doesn't. And that sounds absolutely nuts. It sounds stupid, but you need to have the confidence to hold the trade to the target, or to hold the trade for whatever the target may be. Trading to start with an actual price target, time target, whatever. And you need to be, once you've taken the trade, okay, that's the right decision. I'm certain that's the right decision, but I've got to stop if that trade doesn't work, because there's a difference between if it's a profitable trade and a right decision. And I think you get this, right? Making the right decision, you can do that time after time after time after time after time. That doesn't guarantee winning trade, winning trade, winning trade. It's a distinct separator. But if you can make the right decision and flood yourself with certainty when you make that decision, and you've got to stop if it turns out to be a losing trade, you're in a great, powerful position. The confidence just goes boom through the roof then. And there's actually a discussion then about overconfidence, separate topic. But if you can make decisions correctly and the right decision, and also when you review, Not saying, oh, that was the wrong decision. No, no, it was the right decision at the time. It might have been a losing trade. There's a difference. A losing trade is not a poor decision. If you say, I've got this evidence, this evidence, this evidence as part of my plan, I took the trade, I took a stop, that's a good decision. That's the correct decision. The more correct decisions you can make, the better you will be, because actually then finding and adjusting the strategy and adjusting little tweaks and little levers to pull to make that strategy more effective is actually the easier part. Making the good decisions in the heat of the moment is the tough part, because as we said at the beginning, we're just hardwired to make crappy decisions, and we can change that. So another one is to get yourself a buddy, trading mentor. Honestly, a third party observing things objectively is a game changer for some people, because they look at it and go, well, listen, pal, it's pretty obvious that you took that trade because you lost the first one. You were way too eager. You got stopped out on that good trade. You chased that. No, 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 that's not a good decision. And they go, yeah, you know what? You're right. I didn't see that, but you're right. That prior losing trade really annoyed me and made me have FOMO for the next trade because I felt like I got stopped out in the pullback, blah, blah, blah. And you're anchoring bias. Listen, you've got a great entry there, but you snatched your profits too early. Look at it objectively. If you take away your entry mark on the chart and you look at the chart, you go, there's no reason to close this trade. It's flagging at highs. Off we go, all aboard. I'm not gonna even consider closing the trade. So just thinking about that, it could be a mentor, it could be a trading buddy, anything that the third party who understands trading, just objectively assessing things and saying, listen, you know what? I don't think that was the best decision. You got away with that, but if I was you, be very careful. Yeah, so something to consider. And if you're in Traders Mastermind, I know many of you are here. We have the trading buddy system allocated to trading buddy. It's been a really good program for some people. So, and if you're not, fine. That's okay. Find one. There's places you can find a trading buddy. You go online, you go on Twitter, you can go onto forums. You just put the feelers out. And there's sometimes, even if they're not in the same sort of trading market as you, time frame as you, style as you, that's okay. They still understand the decision making process, whatever they're doing. And so that third party observation can help massively. So that's one thing. Okay. So your homework. Does that word make you cringe and make you shudder? Like back at school, like homework. Holstead, chalk getting thrown at you. You've not done your homework. Yes. Okay. Consider how you make decisions. How much information do you really need? Think about that. What do you need to make a decision? Because knowing that helps you in the heat of the moment of trading day. You've got a decision making process to follow. How do you combat poor decisions? How do you audit your decisions? Another thing is just visualize yourself making better decisions in the heat of the moment. How to make a decision. Okay, I'm looking at this, and this. Is that enough? Is that too much? No, that's right. And just thinking of things through the lens of decisions, not performance, not trades, not correct direction, how you made the decision. This is separated from traders who excel in this business and traders who are floundering. Is they think of things differently. They come up with different ways of framing things when they're auditing and reviewing. And one way to do this is to say, how do I make them my decisions? These good decisions. How do I stop myself making a poor decision again? Not a bad trade. How do I stop myself making a poor decision, which in this case resulted in a bad trade because I was on tilt, I was anchoring it, whatever it may be. So thinking about it through that lens of how am I making my decisions? Self-awareness, being aware that you're a human being, right? You're fallible to these biases. Don't fall into the trap of going, well, I'm me and I don't do this, because we're humans, right? We're all wired very, very similarly. Some of us have strengths in one area, some of us have strengths in the other. Yes, fine, there's the nuances there, but we're all human beings with a brain that comes from, caveman times. Audit your emotion, cross-reference the decisions against these main biases. And you're never going to get things perfect. You're going to make mistakes forever. So accept that and be at peace with that, but you can make improvements so you don't make big mistakes. You will still 20, 30, 40 years down the line, if you're trading, still make an error. Still go, you know what? That was a little bit of confirmation bias in that, but you'll catch it quicker and it won't be so detrimental. Even, example, Bill Ackman. I think he made a real error with his Herbalife. This was years ago now. How many years ago was this? Maybe you don't know what I'm talking about. Bill Ackman, hedge fund manager, he had this big bin in his bonnet about the Herbalife short, saying it was this and that and the other. And he kind of just kept adding fuel to the fire, had research doing this. He took out a massive short position. He was completely wrong. Carl Icahn took the opposite side of his trade. He made money from him. Go and read up on it. It's fascinating if you're into the markets. But he's a really super successful hedge fund manager. And even he fell foul to that at that point, at the peak of his career. I think he's still at his peak of his career now. But You get the point. We're not infallible. No one's infallible, but we get better at managing the decisions and coming up with the correct format to make better decisions. So that's it, guys. Let's do some Q&A. If you've got any questions, I'm happy to answer them. If you haven't joined my email list yet, it's a great way to kind of get more stuff from me. If you like this type of stuff, daily email goes out. It's actually more like 10,000 people now, but 10,000 traders. That's a really good way to kind of keep in the loop of this kind of stuff that I'm doing, and I'm share some ideas and thoughts, strategies, mindset stuff. A podcast, of course. You can check that out, tradersmastermind.com, and do follow Mr. M. Brown on Twitter for your updates about the market, about some of the economic stuff. So it's not too nerdy, but at least you understand what's going on, because at the moment, CPI is driving stuff, which we know. Okay. If there are any questions, ladies and gents, I will take them. If there aren't, we'll call it an evening. Okay, I see a few coming in. And by the way, next webinar, we are. Yeah, he's asking me to go to the homework slide. Yeah, let me put that on while I'm talking. Anonymous attendee. Our next webinar, we're going to be talking a little bit about same theme, trading psychology, but drills and skills to really help improve your psychology, to help you overcome some of these are operational things, like take a trade when this happens, or do this and do that. I'm not going to go into it now, but really useful things to overcome hurdles and barriers. Some of the stuff that in the old days you sit down in London prop firms, you sit at the desk, I'll do this drill, and to get you over and get you used to doing stuff. So we're going to talk about drills and skills a couple of weeks time. I'll make sure on the Pepperstones, Pepperstones email list, and I'll send it out to you. And of course, if you're on my email list, I'll send you a notification of that when it comes out. Okay. I don't know how to pronounce your name. Sorry, pal. But how do I make a trading plan? I've got a post actually. If you go to tradersmastermind.com and you go to blog and you look somewhere on there, there's a massive post that I've done where I talk about how to make a trading plan, the nuances, what you put in it, what you don't put in it. There's some free PDF downloads there, the Google Docs link there. It's a really in-depth thing. I took a long time to do it, and that will give you all the answers, and it will really help you. In summary, you just need to put everything that you want to do in your plan, what your strategy is, what your filters are, what your trigger is, how much you're going to risk, what markets you're going to trade, and all that other good stuff. So yeah, check that out. It is somewhere, I don't know the exact link, but tradersmastermind.com. Click on the Learn tab, click on blog, and you'll find it. How to create a trading plan. Really in-depth guide. I think it's I wrote it, so I think it's all right. I think it'll help you out. So there's that. Okay. Thanks, ladies and gents. I think we are done. Cheers, Esben. Thank you very much. Thank you very much for your feedback, guys. And we shall see you 2 weeks' time. Otherwise, if you remember, we'll see you on Thursday. Take care, guys. Bye bye. Keep your risk managed.